Hi, I'm Michele Santangelo. I'm a fund manager at Vunani Private Clients. I manage an array of personal share portfolios and unit trusts, focusing on small and mid-cap portfolios and large cap growth portfolios, and as well as a multi-strategy hedge fund. So it's quite a lot that I handle, and I'm quite knowledgeable about investing for the long term and quite useful at trading in the short term. We're going to be talking about investing for the long term. So just to get started, I think why invest for the long term? I think everybody has got their own objectives. They've got their own ideas of what they'd like to do in the future. Everyone wants to retire comfortably. Everyone wants to be able to pay for their education or start their own business or become financially independent. And no matter what your objective is, I still believe the best place to invest for the long term is in the equity and listed property markets. And as I've indicated, they're both very accessible on the JSE. There's a number of shares and listed property companies that are very easy to trade in and out of on a daily basis. Just a quote that I did see, and with money, people want to become rich overnight. With religion, people want a spot in heaven. And with diet, people want to lose weight effortlessly and without sacrificing too much. And that's what everybody wants, but in reality, it is actually the opposite. And what I've got here is the all-share index performance over the last 10 years, and I just wanted to indicate how profitable investing for the long term actually is, and ignoring all the noise that happens on a daily basis. If you had invested in an index tracker over the last 10 years and you'd reinvested all your dividends into that same portfolio, you would have achieved 469% total return. So that's 19.16% every single year over the last 10 years. And that's massively outweighs any sort of inflation that we've seen over the same period. And at the same point in time, just notice that in 2007, 2008, we did have a spectacular market crash, and that doesn't even really show up when you analyze the market over the long term. And here we've got the S&P 500 index over the last 10 years, also measured in rands, so not in dollars. And you can see that the JSE has been a fantastic investment. It's even outperformed the US market. The US market's only given you a 14.5% return, but either way, you're looking at really solid annual returns consistently. And that's why we really believe in investing for the long term. It allows you to ignore all the noise over the short term and really benefit from long-term growth. And once again, here it depicts the 2007, 2009 market correction quite clearly, and the statistics are quite clear. It always takes about 2 years for the market to recover the losses of any major correction, and that spans all the way since 1995 and even before that globally. So if you're investing in the long term, you don't need to worry all the time about a market collapse, because your objectives are to grow over the longer term. So what I've got here is actually called the Kona probability, and the data that I have here is based on the United States, and it basically just shows that the longer you hold your investment for, the less likely you're going to have any sort of negative return. So if you hold an investment over a 1-year period, you're obviously going to have huge amounts of potential upside. So over 1 year, 52.6% potential upside, but also at the same time, you could potentially lose 26.5% of your money. And that range of volatility of returns does decrease as your holding period extends further and further out. So you're going to see a lot less volatility in terms of your investments over the longer term, and that's quite an attractive investment perspective. And the most important thing is that it allows you to weather weak periods in the market, and when you're trading in a short or medium term, those short-term market moves are quite damaging psychologically if you're not on the right side. And when we talk about emotions and investing, you should try and keep those as far out as possible, and that's what investing over the longer term does. Take that away take that mental pressure away from you. This is quite quite an interesting bit of statistics that I pulled over the last week or so, and it's just if you were trading the top 40 index over the last 8 years, and it's got an array of just technical indicators. There are quite basic indicators that I've back tested. I haven't adjusted them and tweaked them and made them efficient in any way. So I won't overly read into those numbers. But basically, over the last 8 years, you only had to do one trade, and it was the best trade, and that was the buy and hold strategy, giving you a total return of about 289% over that period. The next best strategy was a Bollinger Band strategy. So you would have traded about 56 times based on the Bollinger Bands, and you still would have only, well, just barely reached the buy and hold strategy. So when you're looking at all the other technical indicators, many are profitable, many are terrible indicators and actually provide you with a loss, like the moving average oscillators. 70% negative return over an 8-year period is quite poor. And also there's trading costs. The more, if you trade on a rate of change indicator or accumulation distribution oscillator, there's a huge amount of actual trading that happens, and your costs do erode quite significantly into your overall earnings. So while I like the long term, it's profitable and it's far simpler, and it's has the lowest transaction cost as well. So the process to long-term investing is certainly not a short one. It certainly isn't an easy one, but it has to start somewhere, and starting is the most important. You've got to think about what your strategy is, think about where you want to be in 10 years or longer. You need to analyze what your process is, and you need to plan how you're going to implement it and keep doing the same thing over and over and over again. It's not simply just buying and holding and forgetting about it forever. It's a continual process that you have to always follow and always analyze. So I'm going to go through my rules for successful long-term investing, and I think that the same does apply in many cases to shorter-term trading and picking shares. But the first and probably the most important is you actually have to start somewhere. And my cartoon there says, according to the experts, I should have started investing when I was in the womb. And that's exactly right. You can never start too early. My son, I started investing his money already when he was 1 month old, and hopefully he'll benefit from that well into the future. So once you've started, and that's always sometimes the most daunting prospect, is you actually need to save whenever you can and save as much as you can. And it's very disappointing that South Africa has got such a terrible savings culture and such a poor savings rate, because with all those savings you can do so much more to start on your own business, to take pressure off the government in terms of services that they need to provide. There's so much that can be done to grow yourself, your investments, your family, and the economy with efficient saving. Once you've started and you've got your strategy that in terms of you know how much you want to save, and you want to save all the time, you really need to match your investments to what your risk profile is. And there's a number of different types of risk profiles. The basics are just conservative, moderate, and aggressive. And basically those measure how an investor can handle the volatility of their returns over time. So a conservative investor would obviously want some income and want to maintain their capital appreciation, and that means that they're not going to be invested in highly volatile sectors like the equity market. They'll probably be more invested in cash and bonds and the like. And on the other spectrum, you've got the aggressive investor who's going to be majority in equities and listed property, and very little amounts in cash. And investors need to understand that not taking the risk, so by not being an aggressive investor over the long term, you are going to suffer, and you not taking any risk is the biggest risk of all. So even if you're a 20-year-old and you investing and you've got a 20, 30, 40-year time horizon, you certainly shouldn't be nowhere near a conservative approach. And in the chart below, it shows you that if you're sitting on only 40% allocation to equities and the rest in cash and money market instruments, you're certainly going to underperform and lose out on quite a lot. So even if you're conservative, you need to take on the risk, especially as your investment time horizon gets longer and longer. And most importantly, and following on from the type of investor's point of view, you need to invest in growth assets. You can't sit in cash, especially if you just keep it under your mattress. It yields 0% forever. And money market rates certainly barely match inflation, and that's one of the most worst things to happen to your money is inflation eroding the value of it. So you need to invest in growth assets, and I've just put a chart below that you can see how the various indexes have performed since 2007, 2008, and that includes the big correction we had then. And property, mid-caps, and all shares is by far the highest returns, but also a lot more volatile. You can see cash gave you maybe about 50% over that period, but certainly with no volatility, but you would have certainly lost out if you weren't invested in the markets. Bonds also there, but also much lower than where you want to be in terms of long-term growth. So this was the most data I could probably find, and it was from the United States. It's 200 years of proof that long-term investing is profitable. And it starts back in 1802, and if you invested $1 in stocks, and that includes property, stocks, and equities, you would have had 12.7 million rand today. Now I know, or in 2006, I know that most people won't live 200 years, but certainly you want to be able to participate in that growth. This just shows how stocks consistently outperform all the other instruments. And one thing I do want to point out is how poor gold has performed. Gold is traditionally a inflation hedge, and that's exactly what it has done. It's just sort of matched inflation, and that's just for all the gold bulls out there. Rule number 5 for successful long-term investing is you have to have a plan. You can't just open a stockbroking account and decide to buy some penny shares. That's not a plan. You need to have your objectives in place of how long you want to invest for, how much you're going to contribute regularly, and you need to stick to it. And once you've got that plan and you're sticking to it, you need to you can only change it when your actual objectives change, and you need to be dynamic with your overall portfolio if your objectives do change, because circumstances do change quite often, and you need to be cognizant of how those changes are going to affect your portfolio, and you need to be able to change your portfolio to match the renewed objectives. The next point I want to say is pick a strategy and stick with it, because in the investment world we call it style drift, and that's when fund managers have a strategy, and then because it stops working over the short term, they start changing their investment style from their traditional investment style that has worked in the past. And that's always the worst thing to do. A lot of specialist investors will not want to invest in fund managers that have style drift. So when you've picked your own style for your own investments and your own trading, you need to stick with it, because no investment strategy consistently works all the time. If you looked at the value investors, they had a really poor last 5 years. They did have a really good 6 months of this first half of this year, but they're giving it back quite aggressively once again. So pick a strategy and stick with it. Don't chop and change around. And the next point is you've got to review your portfolio regularly, and this is something that long-term investors do often forget about. You need to be cognizant of what's happening in the markets, what's happening to your shares, what's the environment that the shares that you own operate in, and how are those factors going to impact your overall investment. Because even though you're investing for the long term, doesn't mean that you're going to hold every single share for indefinitely. So follow your shares. And one thing I do like to do, and I do it myself, and I do advise my clients to do it as well, is experience the shares you invest in, products and services, as much as you can. It's not very practical all the time, but if you're an investor in ShopRite, go to their store, see what they're doing, see what their sales are like. If they're having too many sales, that's a warning sign. So just experience the shares that you're invested in. Often you'll see if the shops are quiet, for example. It's a good indication of a weakening economy, or just that the products that the share you invested in aren't quite there. One thing you should always keep in mind is that you always hear the old story, keep the winners and cut the losers. So it's the same story here. You've got to keep the winners, but sell the shares that are only showing fundamental red flags. So just because if you're holding a great share that's had a good rally and maybe has been sideways for 6 months or a year, don't sell that share just because it's going sideways. You need to see if there's an actual fundamental red flag. And one stock that just comes to mind right now is Famous Brands, which released their results a day or so ago. And that stock has been a fantastic performer recently, or over the last couple of years. And the share price had run up probably ahead of itself, and has been trading sideways for the last year. And the latest set of numbers that came out were fantastic. They were really showing a good quality business that's been run really well by management, and they're doing all the right things even in a tough environment. So there's no fundamental red flag there, and I'd only sell on actual red flag, not just because the share has maybe been sideways for a while. And that leads on again to the next rule, and you need to have discipline and patience when you're investing in the long term. So if you don't have either of those, you're going to struggle to ride any short-term ups and downs, and you really do need to ride out anything and be disciplined not to cut your investments just because the market might look a little bit iffy in the short term. And the same thing goes the other way around, is don't switch between investments just because one or because one sector might be going up in the short term. Don't switch your whole portfolio just because the short-term trade is on for resources to rally, for example. So be disciplined and be patient with yourself. Let the market guide you, and don't just follow the herd if you're a long-term investor. Reinvesting as much as possible is also something that people sometimes forget about. They get their dividends in their portfolio and sometimes withdraw it and don't reinvest it. And this is once again the same chart as we looked at earlier on, which was on the all-share index over the last 10 years. And if you had reinvested, so if you had been paid out dividend and reinvested it into the index, you would have done 19.1% annually. But if you hadn't, and you just take every time you got a dividend paid out and you use that to pay your car off or something like that, you would have only got 15.64%. So that's about 150% difference in total return over 10 years, which is quite significant a difference. So when you're investing in the long term, I've mentioned it before, keep reinvesting, put as much money as you can in consistently all the time. And that your investments will compound and continue to compound. The more money you put in, the more returns you get. You reinvest those returns. The compounding has fantastic effects for that. And Rand cost averaging, that's, for those of you who don't know, that's the basically just continually adding money into the market. So if you invested in the dip in 2007, 2008, you would have been continually buying the market at lower prices. And as a long-term investor, that's fantastic. And you would have been benefiting from those lower prices even now. So I still believe that if the market has a good correction, it's very healthy and it's a good opportunity to add to your investments, not to panic and sell them out just because things are looking a little bit troublesome. The next point for long-term investing is you need to diversify your investments, but not too much. And we typically hold about 18 to 22 shares in our equity portfolios, our pure equity portfolios. So you want to be able to benefit from holding good shares, but you also don't want to have a massive array of instruments and small caps and penny shares and large caps without any real strategy. So you need to be diversified because you obviously don't want to have all your investments in one place, but you also don't want to be overly diversified where you're not getting any benefit from being a good investor. So typically we do spread investments across the asset classes, and our favorites still are property stocks and general equities. But there is certainly a space for utilizing derivatives and utilizing a smaller cap, higher risk shares in your portfolio. But once again, you need to realize that there's a lot more risk with the derivatives and very small caps, and you need to manage that risk by not over allocating investments to that. Every investment and investment strategy has a place, but certainly just be cognizant of the risk that is attached to each of those. This is something which I think the investors are overly concerned about, and it's true. Market timing is impossible. I think if you asked investors in the market at the moment, whether they're traders, long-term investors, specialists, I think half of them will say the market's going up and half of them will say it's going down from here. So market timing is impossible. So as a long-term investor, it's about time in the market and not timing the market. So what we do advocate, though, however, is managing your exposure to the risk, because that is very logical and possible. So if you're a long-term investor and you're very nervous about the market, you can certainly hedge your portfolio a little bit using derivatives. You don't have to gear yourself, but you can certainly protect and maybe take your exposure a little bit lower to some of the more volatile assets. But over the longer term, you certainly want to still be invested as much as possible in the riskier investments. And ignore short-term market swings and focus on the big picture. I think with the rise of the internet and of TV, investors are always looking for, always getting inundated with information and views from so many people. It's more advisable to ignore all the noise and just focus on the long term and choosing good quality companies that you can invest in and hold on for the long term. So remember, over the longer term, company fundamentals and economics drives long-term investment decisions, and that's a far more predictable aspect to investing than the greed and fear that drives the short-term trading and the market noise over the very short term. And that we've seen over the last couple of weeks. The market seemed like it was the end of the world 2 weeks ago, and now we're nearly back at where we were. So that ignoring that, if you had cut your position lower down, you would have been a good couple of percent already in the wrong. The next point I want to chat about, and it's a rule that investors, I think, overly concentrate on, and you must be concerned about fees because you don't want to be overcharged for anything, but you mustn't purely base your investment decisions on that. So if you've got a really good stockbroker who's maybe giving you 80% of the last trades right, and he's made you lots of money, and you work very well with him, they gave you great research, pay that stockbroker, because they're providing you a fantastic service and they're helping you to grow your long-term investments or your short-term investments. So it's a lot better to pay a little bit more and get quality research and quality advice rather than having a cutthroat brokerage rate and losing 80% of your money. So just be cognizant of that, but don't base any decisions fully on it. And the same thing goes if you're investing in a longer-term unit trust or something like that. Just because that fund manager might have a higher total expense ratio does not mean that he's underperforming his peers. Often what happens is long-term investors are overly worried that the expense ratio of their fund is slightly higher than everyone else. But if that fund manager consistently outperforms the equity market and their peers, then it's still a good place to be, and you're still outperforming everybody else, even though you're paying slightly higher fees. And I think this is my last rule for the moment, and it's don't follow the hot tips. Because generally, if you've heard of a hot tip, it means that there's a lot of other investors and traders that have heard the same thing, and trust me, you're probably one of the last people to actually hear about the hot tip. So we advocate resisting the lure of high-risk penny stocks. We prefer to invest in really well-researched shares, so that includes this really small-cap stocks, mid-cap space. If a stock is very well researched, it's got strong fundamentals, it's got a good management track record, those still make really good investments. But it's just the stock tip of what you heard over the bar, over a beer, and your mate says that his cousin's friend told you about the stock and it sounds really good. That's not the way to invest. So moving on to the investment philosophy, everybody should have an investment philosophy. We certainly do. So you can either have your own one or you can follow ours, and I've just briefly put some points at the bottom about our investment philosophy across our portfolios that we run. And the basic crux of our philosophy is to invest in shares that can show consistent business and share price performance. So to go a little more in depth, that we look for attractively valued companies. Doesn't necessarily mean cheap companies, but that have got good track records, improving earnings outlooks, and are receiving growing investors' attention. So that means that the company is doing well fundamentally. The forecasts are still looking good for its earnings growth, and that the share price is actually going up. And that's an important point, is that there's lots of quality businesses out there, but the market isn't rewarding those companies for their good performance. And and there's no point in being invested in a stock that's doing well but no one's buying it. And that's important, as we invest in shares that have the whole package, that shares are being rewarded for their good performance and are trending up and rewarding you for investing in that stock. Some of the metrics that we consistently analyze, and that's consistent and increasing returns on equity and returns on capital. And these are quite easy to pick up, and you can plot those, and you can see the stocks which show consistent returns on equity of 15 to 25%. Those are really good quality businesses. They can consistently provide that over a prolonged period of time. And the next point is analyzing the total returns over multiple time frames, and that boils down to where stocks have been rewarded for the good work that they're actually doing. So if a stock has been going up by 20% per year, and I love using the example of Mr. Price, which has been growing earnings in excess of 20% every year for over a decade and a half, that's exactly the kind of quality stock that you want to invest in. And just because it's gone up 20% last year, it's got more of a likelihood of going up another 20% than falling if all the metrics are in place. The next point is quite a simple one, and anyone can analyze this again, and that's consistent headline earnings per share and revenue growth. Headline earnings takes away any of the once-off items in their earnings and just shows how well operationally they are doing. And the next point, revenue growth. If a company is consistently showing solid sales growth and revenue growth, it means the company has demand for their products and are actually growing their output, which is always great. The next point, competitive advantages. That's always one of the biggest points, and competitive advantages do bring about higher margins in the business, and higher margins means higher potential profits as well. So always look out for a stock that's got a great competitive advantage in the sector that they operate in. And once again, stocks don't operate in a vacuum. They do operate in a macro and a sectoral environment. So if you look at sort of the mining sector at the moment, it's in a really tough space. We've got commodity prices declining, and in the short term they still are looking quite suspect. But that's why you probably shouldn't be invested in some of the mining stocks just yet, because that sector environment is still tough and still hasn't reversed quite yet. And that's why you need to be cognizant of how the different sectors are actually operating. And the same thing goes for our retailers. At the beginning of the year, a lot of the retailers have come off quite aggressively. Lots of profits been taken off the table, and that's simply because locally we've been in such a tough environment for them. So you need to know how operationally they are weathering their sector environment. And then one thing that I think is very important for every investor, and you shouldn't be overly concerned about valuations and theoretical share price targets. And every single day there's an upgrade or a downgrade on share prices based on analysts' fundamental price targets. You'll find that good shares shoot way past those share price targets on the upside, and then lots of poor quality shares often break well below those price targets consistently. And I look at the likes of Aspen, which is blowing share price targets consistently. Analysts have been upgrading that stock, but they're always behind. So don't always worry about a theoretical share price. I know there's a well-known small cap analyst who's been calling EOH a sell since 32 Rand. I think today it's about 102. So, and that's exactly what does happen in the market quite a lot. And I know everyone listening here is involved in the short-term trading game at the moment. So these principles do apply in the short term. So in our shorter term strategies, we buy the best stocks on the dips, and we short the poor quality shares on the rallies. And the same thing goes when you're on the breakouts and breakdowns. We buy the good quality stocks and breaks the upside, and we short the poor quality shares on the breaks to the downside. So those are what you can look at. Once you've done all your metrics, you know which are the good quality shares, you know which ones are the poor quality shares, and you look for the opportunities to trade those shares in the direction of their fundamentals. And I think that's the most important point for trading in the short term for me for this. And just the final thought for investing in the long term, you need to invest in quality companies, and you need to give them time and space they need to grow and to grow your portfolio. If you need any guidance, you're more than welcome to give us a shout.